Hey Samvan, this is Ria from Samaya, MCQ 51, CA Final. B Private Limited is having three subsidiaries, one in India, Ireland, and France. The audit of France was unavailable, so we cannot make the audit report as of the release date of CFS of the parent company B Private Limited. So they were asking a suggestion. So since the audit of French company was in progress, the auditor shall sign the financial statement, and the financial statements of French company would be released after the release of CFS. No, you cannot do that. And the management should give management accounts. No, it has to be audited, and whether it has to be audited by a CA level in the other country or Indian CA. The auditor should get financial and statements excluded from CFS. No, excluding a component is so significant matter. He should modify his report as per S700. If the auditor does not receive audited financial statements of French company, he should modify his report. Yes, this is the most appropriate answer. Option D. Hey Samfam, this is Rhea from Samaya. MCQ 52, CA Final. K Limited is having a subsidiary in Germany. It has acquired in the current year, and the management is of the view that the consolidation is not required because it acquired it's in this year only. But the auditors have not agreed for the same. That should be the case. And the financial statements for the Germany company were prepared as per gap in such Germany country, and they were converted into Indian company for the consolidations. And such consolidation adjustments were significant, and they were material. There was such adjustments were significant, and they're asking us whether they have to consolidate the Germany subsidiary and whether the conversion adjustments also have to be audited or not. Yes, the Germany company should be consolidated. Plus, the conversions of the consolidation adjustments from other country gap to Indian gap should also be audited. We'll see in which option consolidation should be done and gap not required. No, gap conversions should also be audited. In option C, consolidation of that company should be done. Yes, and gap also should require to be audited. Yes, option C is more appropriate answer. Hey Samson, this is Jaya from Samaya, NCQ 53, CA Final. V Limited has two subsidiaries and one joint venture. One of its subsidiaries had changed the method of depreciation of PPE from written down value method to straight line method, and another subsidiary changed the valuation from FIFO to weighted average method. You see, changing the method of depreciation is just an accounting estimate, but not an accounting policy. What all the things that have to be aligned was accounting policies. So from FIFO to weighted average, this is an accounting policy. Change of method of inventory, method of valuation of inventory. So they're asking us whether this change in depreciation and change in this valuation of inventory were should be aligned with the parent company or not. The depreciation need not be, because depreciation is just an accounting estimate, and the method of valuation of inventory should be aligned. So for CF is option B. Method of depreciation may continue to be different as it's an accounting estimate. However, valuation of inventory should be aligned with that of company because that is an accounting policy. So option B is more appropriate. Hey Sampham, this is Ria from Samaya, MCQ 54, CA Final. A Limited is having three associates, four subsidiaries, and one joint venture. It's preparing it's preparing for the audit of CFS for the year ended 31st March 2021. As the audit of the joint venture was not yet complete, it had insisted that they could provide only 75% of total assets of the group at the consolidated level. Then what the statutory auditors insisted is that at least 80% should be done. Please advise. What they are saying is that we have also seen similar kind of MCQs previously, right? What's the answer for this is what the auditor has to do is have to modify the audit report with regards to 700 series. So we'll see that option here. Auditor should accept management certified accounts and evaluate implications on audit report and qualification with regards to SC 705. This is most appropriate answer. We'll see other also. Auditor cannot accept management report to registrar. No. They have to report to SEBI. No. They have to accept the management certified, and revenue of joint venture is less than 10% of the group. No. Missing a kind of component is a significant matter. So we have to modify the report. So option A is more appropriate. And subscribe, like, and share it with your friends. Thank you. This is Ria from Samaya, MCQ 55, CA Final. A Limited is having subsidiaries, associates, and joint ventures. A is the auditor of statutory audit of the parent company, and K is the statutory auditor of all components. Now, what A is saying that he also wanted to do audit or limited review of all the components that are consolidating with the parent company. That is, he is using the work of the other auditor. He's using the work of the K Limited for the branches. He could use that, but what's the presumption is that you have to believe you could work the review of the such other auditors, but you need not do the audit or limited review. What you could do is that the presumption is that he had done the audit. He has done the audit as per the standards on accounting and GAAP. So we'll see which is they're asking us please advise what we have to do. In an audit or review of CFS, principal auditor shall require to perform various procedures as per SS 600. No, he need not do that. He could guide if for the other branch auditor, but he need not redo the work. In an audit, principal auditor is required to perform various procedures. He need not do that. In an audit or review, the principal auditor is not required to re-perform the audit or limited review of the components as there's a presumption that the branch auditor or the other auditor was doing his job perfectly. If he want, he could go for inspection, but he did not do the audit or limited review again. Management decide mutually. Management and auditor need to decide mutually, as this is based on contractual agreement between them. No, they have to do work as per what standards were saying. So option C is more appropriate. Please like this video and share it with your friends, and please do subscribe for more. Hey Samfim, this is Ria from Samaya, MCQ 56, CA Final. Entity P is audited by a different auditor than its parent entity Q. The principal auditor of entity Q decides to use the work of auditor of the component P in relation to the audit of CFS. In doing so, he should comply with what requirements? Option A, SA 600 series using the work of another auditor, SA 200, joint audit of financial statements, SA 720, the auditor's responsibility relating to other information, SRS 4410, compilation engagements. He has to comply with requirements of SA 600 using the work of another auditor. Thank you. Like this video and please do subscribe for more. Hey Samvam, this is Jaya from Samaya, MCQ 57, CA Final. Your internal auditor of F Bank, and you are instructed by your senior to verify the loans against FDs. And as per the scope, you have to check whether the fixed deposits against which loan has been issued have been taken a proper lien or not. What the following procedure you will follow? Option A, ensure that all fixed deposit receipts are attached along with the approved loan documents. That's not how you check the lien. Lien is something the name has been changed to the bank. Ensure that the fixed deposit receipts against which loan has been sanctioned and are discharged in favor of the bank. Yes, this is the key point. You're discharged in the favor of bank and check the lien whether it's marked in computer software or not. Yes, I think this is the most appropriate. We'll see others also. Discuss process follow, no discussions. Ensure that they have been sanctioned and discharged in favor of bank and check the lien and the fixed deposit should be kept separately and need not be kept separately. So option B is more appropriate answer. Please do like this video and share it with your friends. And this is Ria from Samaya, Institute 58, CA Final. Your firm has been appointed as statutory auditors for PFS Bank, and your senior asked to verify the transactions of portfolio management services, that is PMS services, and you're verifying those transactions and found out that the bank has not prepared separate record for PMS transactions and for bank's own investment. PMS transactions were something that the bank is managing some third parties or managing the funds or investments of its clients. There has to be a separate record for its own investments and clients or the managing assets. So as per RBI, the statutory auditor of the bank should not audit such PMS transaction. There has to be an external third party auditor who has to audit such a PMS transaction because bank it is operating in a separate entity kind of way. It's providing separate kind of a service, right? Apart from its banking transaction, it's providing fund management services. So we'll see which option is more correct. And it's not necessary to maintain, no, it has to maintain PMS clients and banks' own investments. So option A is wrong. As per RBI guidelines, PMS investment need to be audited separately by external auditors. Yes, this is the most appropriate. Auto can give qualified opinion. No, it doesn't come under the scope of the statutory auditor, the PMS investment. So we cannot give qualified opinion, and auditor should verify PMS not utilized for lending, and so whether PMS transaction auditor will not matter for the auditor. The option D is purely wrong. So option B is more appropriate. They need to be audited separately by external auditors, and they have to maintain separate books of accounts. So option B is more appropriate. Please welcome, this is Ria from Samaya and CQ 59 CA Final. You are appointed as a statutory auditor for a nationalized bank, and you are asked checking standard assets, and you found that there was an NPA that was overdue for the quarter ending 30th September, but it was paid and was regularized, and all the installments and interest was paid right before the year end. So what you have to do is you have to, as the interest charged in the account was overdue for more than 90 days, you should be classified as an NPA and considered as such substandard asset for the 31st March 2021. No. Since all the payment was done, even though it was before the year end, you have to check whether such payment is through genuine resources or not. Then you need not substandardize asset. The bank could regularize that asset. So option A is not relevant and auto should not agree or no, no that's not a reason and yeah, option D is more appropriate. Bank can regularize the account before balance sheet date, but should ensure that the amount has been paid through genuine resources and not by sanction of additional facilities. That is, the bank should not give additional loan in order to not make the old loan non-NPA or to make the old loan regularized. So option D is more appropriate. Please do like, share, and practice your MCQs in our Telegram channel. We are posting it. Hey Samson, this is Ria from Samaya, CA Final, MCQ 60. A bank had an NPA account which has recoverable amount of rupees 55 lakhs in its books, but it sold that NPA for 56 lakhs. So there's a profit of 1 lakh. So they're asking about how to properly account that. Credit such excess 1 lakh to profit on sales of accounts. No, we have to not recognize the profit on sale of account. What we have to do is that we have to transfer it to the provision for loss on sale of NPAs to compensate any kind of loss that had occurred due to the sale of NPA. So option A is not right and let the amount remain in Glen Park account. No. The credit of excess rupees 1 lakh to provision of loss on sale of NPAs. Yes. That is that is what we have to transfer. That is because we have got 1 lakh profit here. It is not that we end up in a profit for sale of all NPAs. So so option C is more appropriate and option D return of 1 lakh to the party purchasing the NPA. No, who does that? Option C is more appropriate. Please like this and do share it with your friends. Hey Samsung, this is Ria from Samaya, MCQ 61 CA Final. K Limited is a company engaged in general insurance, okay, and it had got a subsidiary which is engaged in other than general insurance, okay. And they are asking us what are the regulations with regards to appointment of the audit firm. They wanted to appoint KB and Associates an audit firm, and the firm should be appointed by Board of Directors of PIC Limited. No. The appointment of auditor of an insurance company, which is a public company, public sector company, or a general insurance company, if it's and its subsidiaries also, the auditor has to be appointed by C&AG. And if it's private, private insurance companies like Max Life Insurance, HDFC, Exide, like them, it could be appointed, the auditors could be appointed in an AGM, provided the auditor had complied with all IRDAI regulations. So we'll see for that option because if they have said limited, it's a public sector company, so C&AG has to appoint. Okay, option B. The firm should be appointed by C&AG and it should ensure that they do not take up more audit of more than 3 insurance companies. Total is 3 insurance companies, but they shouldn't take all the 3 life, all the 3 general insurance. That is not more than 2 life insurance, not more than 2 general insurance has to be taken. B is most appropriate answer. Hey Samsung, this is Ria from Samaya in CQ62 CA Final. N Limited is an insurance company which had centralized all its accounting and operational systems, that is including HO and all its divisions, appointed A&J, a firm of chartered accountants, as statutory auditors for all its divisions. And actually, insurance audit should be a joint audit. It's always a joint audit. It is two or more than 2 audit firms have to audit a insurance company. So they have breached the IRDA regulations, and now what? They have received a notice, and they are asked to respond within 7 days. Why they have asking that? They have breached the IRDA regulations, having a single auditor for all the divisions. Now what they have to do? Yes, there has a breach of IRDA regulations, and management have to respond. Yes, the management should request IRDA consider relaxation. No, the management should respond to IRDA as there is no breach. No, there is a breach. And the management should respond to IRDA that this provision should be ensured that auditors only, hence, they should not be liable for the breach. No, they are liable. So option A is more appropriate. That is, a breach had occurred and the management should respond. Please do leave a like and do subscribe and share it with your friends. This is Ria from Samaya, MCQ 63 CA Final. B Limited is an insurance company and it had got Advik and Associates as its statutory auditors, and it also requested them to certify the investment risk management systems and process of BIC Limited as per discussions with Shivam Limited, which had got a significant influence over BIC Limited. Okay, see, statutory auditors cannot do certification of investment risk management systems and process. It has to be done by some other third party or external auditors. Got a notice from IRDA with regards to non-compliance of the provisions. We'll see. It could also, the auditor of BIC Limited could be appointed by C&AG because it's a public sector company. See, it's limited here. So the auditors cannot be appointed by Shivam. And BIC should have got certification from their internal auditors. No, it should be a third party auditor. BIC Limited should not have got the certification from the statutory auditor, yes. The survey should have been done by Shubham and Associates, no. Option C is more appropriate answer. This is Ria from Samaya and CQ64 CA final. Below is the extract of list of suppliers, and there exists some differences between the statement balance and the payables ledger balance. And in order to audit the difference, what we have to check for? We have to review post year and credit notes for the evidence of acceptance of return. Yes, because there's a difference in sales, we should check for the credit notes and inspect the pre-year and goods returned note. Yes, goods returned and credit notes. Yes, if anything with regards to difference between sale, we have to check for the goods of anything evidence that was with regards to the goods, whether that was sales returns or purchase returns or any kind of goods return notes, etc. And third one is the inspect post year and cash book for evidence that amount has been settled. This is not with regards to any debtors or any cash or loans, right? It is mostly with regards to the purchase or sales. So we have to check for 1 and 2. So option C is more appropriate, 1 and 2. Samsung, this is Ria from Samaya MCQ65 CA final. AJ and Co is a firm of chartered accountants having 10 partners. And if one of the partner had raised a point that the firm can accept tax audit up to the maximum limit. However, other partners have a strong view that the limit on audit is applicable only to statutory audits and not on tax audit. No, if CA can uh, take up to 60 tax audits. If it's a firm, they can collectively sign 600 tax audit. If the firm of 10 auditors, right, 10 partners, they can collectively go for 600. Now we'll see the options. There is no limit for number of tax audit. No, there's a limit 60 per CA. All the partners can collectively sign 450 tax audit. No, per CA 60, right? 60 into 10, 600 tax audit. All partners of the firm can collectively sign 600. Yes, this is most appropriate answer. Option C is right. Samsung, this is Ria from Samaya MCQ66 CA final. R Limited is registered as NBFC and it had total assets 298 CR. That is minimum requirement to be an NBFC is 200 CR. So it had met this criteria 298 CR and it had financial assets 199 CR. That is more than half of what it had total CR and it had generated 99.5 CR as total income. Okay, and its financial income is income from financial assets was 60 CR. That's obviously more than 50 CR. So it has satisfied all the 50-50 test. And the company had also accepted and gave demand deposits. An NBFC can give demand deposits but cannot accept demand deposits. And we'll see which option would be correct. The company does not meet the criteria. NBFC, no, it met the criteria. Does not meet the criteria. It met the criteria. Company meets the criteria of financial but cannot give demand deposits. No, NBFCs can give demand deposits but cannot accept. Only banks can accept demand deposits. They cannot accept, and the statutory auditor should report this with regard to option D is most appropriate answer. Yes, I'm from this is Ria from Samaya MCQ67 CA final. S Limited is a company in which 59% of its paid up share capital held by Punjab government. So it's a government company. And N Limited is a company controlled by S Limited. That is, N is subsidiary of a government company. So N Limited is a deemed government company. So while the audit, N Limited observed that during the course of the audit, there's a lot of intervention by C&AG and it's seeking legal opinion against C&AG. Is this right? No, because Unlimited is a government company, so there should obviously be an intervention of C&AG with regards to appointment of auditors or giving direction for them. So we'll see which of this is right. The stand of existing auditor should have been better and not accept interference of C&AG. No. C&AG involvement is acceptable, but not in case of Unlimited. No, option C is also not valid. And option D, stand of N Limited is wrong as C&AG may get involved in the audit of N Limited. Yes, option D is more appropriate. I'm from this is Ria from Samaya, MCQ 68, CA final. C Limited is engaged in oil exploration and Tamil Nadu government and central government hold 37% and 20% respectively. That is both CG and SG hold 57% in total in C Limited, which makes it a government company. And C&AG appointed statutory auditors and it also wanted to conduct test audit. C&AG also issued an order to conduct test audit, but the management objected that it would lead to duplication of work. Here, the management objection was not valid because C&AG may order for conduct of test audit of accounts when it wanted to do so. So there's no objection in that. We'll see whichever is right. Management stand is not correct. Yes, C&AG may order test audit as per requirements of Companies Act. Yes, most appropriate answer. This is Ria from Samaya. MCQ 69, CA final. N Limited is a joint venture of central government and a private company where central government owns 51% of the company. That is, N Limited is a government company. With that said, C&AG want to conduct performance audit of one of the departments of the company through a subordinate office of Indian Audit and Accounts Department. Yes, because N Limited is a government company, it could be C&AG could involve in conduct of any kind of performance audit or test audit as per the respective act, and we'll see which is most appropriate answer. Management is quite surprised and the company is concerned by the program, which requires a quite detailed and involved a significant amount of time. Yes, there's no issue in that to go for a detailed audit if the C&AG wants. And now we'll see which is most appropriate answer. The notice of such type of audit should give a reasonable time. Yes, this is for sure. The management should prepare for themselves. They should require a reasonable time. Further, it should not be a detailed audit requiring significant time. No, C&AG could go for that. C&AG may conduct such type of audit. However, the notice conducting such type gives a reasonable time for the management to prepare themselves. Yes, option B is more appropriate answer. Yes, I'm from this is Ria from Samaya, MCQ 70, CE final. AG Petroleum and Refineries Limited is a PSU and it engaged in oil refining business and it had appointed the auditor, the C&AG director for the performance audit. And before starting that audit, there was directions and all that were given. However, during the course of the audit team changed its audit program. Whether it could change the audit program, yes, the audit program is dynamic with regards to the risk of material misstatements or materiality they find, they could change the audit plan and audit program with regards to that. And we'll see what's most appropriate answer. Changes in audit program are not acceptable. No, they are acceptable. Changes in audit program are not acceptable. No, acceptable. Changes in audit program can be accepted by providing discussions with the management and approved competent authority. Yes. After when there was a change in audit program or audit plans or strategies, what do you have to do? You have to communicate with the management and moreover the one who appointed you, the competent authority. So option C is more appropriate answer. Hey Samsung, this is Ria from Samayo, MCQ 71 CA final. In case of PSU, direct reporting engagement does not include. Direct reporting engagements were such engagements where the scope was decided by the C&AG or some competent authority. Because it's PSU here, we are talking about C&AG. And of options were performance audit, compliance audit, financial audits, and comprehensive audit. You see, financial audits, the scope was decided by the management, C&AG both together. And for the performance audit, compliance audit, or comprehensive audit, any kind of test of audit, test audit, it was the C&AG directly appoints an officer or a firm to perform such audits. So option C is more appropriate answer because all these three audits were C&AG directly appoints the auditor. For financial audit, even though C&AG appoints the auditor, but the scope and the regulations, directions were also discussed with the management in financial audit. So option C is more appropriate. This is Ria from Samaya, MCQ 72, CA final. The audit committee should consist of the following. Minimum of 3 directors with independent directors forming a majority. This is what actually the answer is as per previous provisions, but as per amended provisions, the correct answer is minimum of 3 directors as members, at least two-thirds should be independent directors. When it's a listed company having outstanding SR equity shares, all members should be independent. The amendment is here, at least two-thirds should be independent directors. And that's the right option. So none of the options here were right, but as per amendments, minimum 3 directors, at least two-thirds directors shall be independent directors. for MCQ 72. Samsung, this is Ria from Samaya, MCQ 73 CA final. ABC is one of top 1000 listed entities on base of market capitalization. The board of directors of ABC Limited do not comprise any women director, but top 1000 listed entities have to get at least one woman independent director. The statutory auditor who is certifying corporate governance as per SEBI regulations has to ascertain that the board of directors will have one, at least one independent women director. So option B is most appropriate. Hey Samsung, this is Ria from Samaya, MCQ 74 CA final. The auditor should ensure that the board of directors of top 100 listed entities shall comprise of how many directors? You see, should be less. It should consist of minimum 6 directors. So option C is most appropriate. Don't get confused with the 7 here. 7 is the minimum number of members for a public company. Not 2 also. 2 is the minimum number of members for private company. So they're talking about directors, so it's not less than 6 directors. It's most appropriate answer. Yes, Samsung, this is Ria from Samaya, MCQ 75 CA final. The board of directors of XYZ Limited, which is one of the top 2000 listed entities, meets 4 times a year. Yes, okay, that's fine. What should be the quorum? Okay, the quorum for a board meeting should be at least one third of the total strength of 3 directors, minimum 3 directors or one third, whichever is higher. Plus, at least one independent director should be present. We'll see the options: one third of the total strength or 3 directors, whichever is higher, yes, including one independent director. Yes, option A is more appropriate answer.